Hello, everyone out there in podcast land. Welcome back to Venture Capital, where we not only discuss the entrepreneurial journeys and adventures with founders who have raised capital on WeFunder, but also the different resource providers and mentors helping founders along the way. Huzzah! Today we have Plappert of Forecastr, an online financial modeling platform that helps founders get a great financial model to impress investors and better run their business. Now, you know we're all about efficiency around these parts. WeFunder gang, take it away.
So, Stephen, welcome to the podcast. Great to have you here.
Thank you, Jonny. It's an honor. I really appreciate it.
Maybe we could start with you giving us an overview of what is Forecastr and how you came to be running the company.
Yeah, I'd love to. So what is Forecastr? So Forecastr is an online software platform that helps founders build great financial models online. So think of it like, what Card is to cap tables, or maybe QuickBooks is to your accounting, or HubSpot or Salesforce are to your sales process. Forecastr is that same type of tool, but for your financial model. And we wrap that solution in some white glove onboarding. We have a team of financial modeling experts that work with founders to help them build these great financial models and kind of get them in a position where they can use the model on their own to run their business, and they can use it to present to investors and raise capital. A lot of founders aren't this isn't their area of expertise, so a lot of times they really benefit from a little bit of help along the way, and we provide that as well. And as far as kind of some company history, we've been around for 2 years now, raised just over 4 million. We've got just over 250 customers using Forecastr now, and it all came from me and Logan. Logan is one of my co-founders. We were working together at an outsourced CFO shop called Venture First, and they were focused on Series A tech companies, helping them with their finance function. And Logan and I were there, building all the financial models for the companies and using QuickBooks and using Carta, and just kind of asking ourselves, why doesn't this one thing look more like these other two things? And that was kind of the nugget of an idea that led us to building Forecastr, and we've had a pretty successful run at it thus far. But there's a little bit of company history and kind of what we do.
How did you get into being an outsourced CFO? And had you started companies before, or?
Yeah, I had. So for Logan, it's his first startup. But for me, I've been in the startup game for about 10 years now. Forecastr is my second company. So I had started a company called Fantasy Hub. It was a consumer company. We did daily fantasy sports. So competing with DraftKings and FanDuel back when it was legally ambiguous. And that was my first kind of foray into entrepreneurship, was building that company, and built it for a few years here in Kentucky, which is my home. I'm from Louisville, Kentucky. But we were actually the first Kentucky company to ever get selected into a Techstars program, which I think is pretty neat. So went down to Techstars Austin. Yeah, back in 2015, it wasn't anybody had done it yet. So we got in there and went down to Techstars Austin, and that was a big experience for me. I think that was pretty illuminating in a lot of ways, but one of those ways was financial modeling. I went through the program, and we had a financial model, but these other 9 companies, it was really the first time I'd engaged in much of like a founder community, and I just saw that the numbers were really challenging for them. Like, they were great product people and tech people and sales people with really strong visions and passions, but just couldn't quite wrap their arms around the mechanics of their business and the number side. And I actually helped a lot of those companies build their models. And then when Fantasy Hub failed, it failed after 3 years. We just didn't have attraction enough for Series A, and there was too many headwinds in the industry. I went to those companies. I said, hey guys, I remember you really struggling with the number side of things. I'm not running Fantasy Hub anymore. We failed, but if you could use some fractional help, I'd love to do that. And actually built up a book of business, doing that on my own for these companies. A handful of companies I was on retainer with, building the models and helping them raise capital, and then cut off all those engagements and spent 6 months in the woods hiking the Appalachian Trail back in 2017. And when I got back, that's when I found Venture First, and I was actually my first and only W-2 job that I didn't supply for myself. So yeah.
And you didn't last very long there before your itchy feet had you wanting to start a company again, by the sound of it.
No, yeah, not at all. I was back there for 6 months. And then we came up with the idea for Forecastr, Logan and I, 6 months in.
Did you meet Logan at Venture First, or you knew him already?
I did, yeah. We were essentially kind of cube mates. Pretty small company. It was a 30-person company at the time, but we were the guys kind of back to back building all the models for the startups. And we met there. We actually both had the idea independently. I had the idea, I started putting my thoughts in the pitch deck, and he came to me one day and spilled his guts on it. And I was like, Logan, check this out. And I brought up
had he hacked into your computer and read the slide deck, do you think?
No.
That's pretty awesome that you just like independently came to the same idea.
Yeah, we saw that as that kind of early validation. It's like, hey, if we're both thinking this, maybe there's something to this. And I think for me, the scar tissue of having a failed startup, I didn't want to rush back into it. I wanted to say, hey, like, we have full-time jobs right now. We're at a really low burn state. Like, let's get through some hurdles. Like, let's do some customer validation and discovery. Let's run some processes to validate this idea. And, before we go leave our jobs and start full time. And we ended up actually incubating it at Venture First for over a year, a little bit in stealth, and then bringing it to Venture First, and Venture First leaning in and investing in the company and
that's awesome.
Helping us get a prototype to market, helping us get that first round done. It ended up being a really great way to launch the company. We launched with a lot of knowledge and never had to skip a paycheck. So
that's really cool. It's really cool when you see kind of several things come together to make you the perfect person to launch this company, right? You had a startup previously. It isn't your first rodeo. You went through Techstars and saw all these other companies kind of needing financial models. So you kind of almost experienced it then. Then you did the kind of outsourced fractional CFO thing, saw it then, kind of build up a book of business, almost like the customer acquisition from a service provision standpoint that then kind of very naturally segued into a SaaS model. It just seems like, all of those experience kind of compounds to make Steven the right person to be running this company. It's awesome.
Yeah, it's definitely, it definitely feels that way from my perspective as well. I'll tell you this, when I first started Fantasy Hub, it was really exciting and I really loved the idea of starting my own company. But, I wasn't a fantasy football guru. I wasn't all about it. It wasn't my lifeblood, that kind of thing. And so that company was always like, it'll always have a really special place in my heart because it was my first company and there's just a certain kind of allure to that. But this one really feels like a company that I was born to build. It really feels like it's just a dead hit with the domain expertise that I have, with what I'm interested in, with what I'm care about. And it feels right.
That's awesome. Have you seen the show Silicon Valley?
I have seen that. Just the first 2 seasons I have, yeah.
It's like about my favorite TV show. It's just so accurate. I don't know if you remember, it's like one episode kind of early on where, Richard goes to see Peter Gregory, the VC. And Peter Gregory's like, show me your cap table, like show me your business plan. Like, why don't you have these things? And then Richard comes out of the meeting. He's like, wait, like what's a business plan? What's a cap table? What is plan? So I guess like when you say financial model, what the hell is a financial model? If there's a founder listening, like, oh, the VC's asking me for a financial model, but like, what is a financial model? I mean, obviously they should go to Forecastr and have you build it for them. But what's the kind of 101 on what a financial model entails?
Yeah, it's a great question, and I'll say this. I'll say it in a couple different ways, so it kind of resonates with different folks. I would say, in a kind of a purist sense, a financial model is essentially a mathematical representation of your business. What a financial model tries to do is take everything that happens in your business. How do you acquire customers? How do you monetize those customers? Who do you need to support that revenue forecast? Like, what kind of expenses do you have? Assets, liabilities, equities, like all of these, cash in, cash out, everything that's happening within your business. It tries to boil it down to a set of mathematical equations, to a set of formulas, if you will, that can calculate, well, if I put this in here, what comes out the other side? So it's an engine, it's a mathematical representation. But I think a great way to look at it, honestly, is it's a business simulator. It's a simulation of your business into the future, so that you can get a sense of how well your business will perform. You can get a sense of kind of what you need to do in order to hit those revenue milestones, or how much cash you need to raise in order to get 18 months worth of runway. It'll kind of give you a lot of data and information about the future of your business so that you can make better decisions. So it's kind of a question and answer exercise, a financial model is. And it's not a crystal ball. I'm always careful to tell people that. It doesn't spit out all the answers. You kind of have to play with it and work with it. But that's really what it is. It's really a simulation of your business into the future. It's like taking your business on a virtual test track so that you can avoid, pitfalls before they happen. You don't have to let something happen and then correct it the next time. You can see the writing on the wall a little bit ahead of time, and you can course correct in advance. I think that's really what a model is. And that's what it can do for you.
I imagine, a financial model in like a biotech company looks extremely different to a financial model in a B2C platform, looks extremely different to a financial model in a restaurant or a brewery. But so firstly, kind of, is that true? Are there kind of common trends or similarities between financial models? Yeah. And then secondly, let's take like an average, maybe you take forecasters, or an example, what are the different, it's like user, like the number of users we have, kind of revenue, does it even make sense to kind of say, these are some common characteristics that all financial models are going to have? Or
honestly, yeah. So that's a question we get a lot. And I think a lot of people feel like there's, there can be a lot of variation in different financial models. And some of that's true. There is a lot of nuance between, like you said, a biotech company or a company that's doing big pharma. Maybe they got to go through FDA approval versus your mom and pop restaurant down the street. But there's a lot of commonality actually between it. And I would say the core kind of building blocks of any great financial model, a financial model that I would consider investor grade, a financial model that I would consider, a strong kind of indicator of financial health, is that at the highest level, you essentially have a set of assumptions, and you have your financials. Those are kind of input and output. The model essentially sits in between, and it takes this set of assumptions and it runs it through a series of calculations, and it produces, a set of financials. That's an income statement, a balance sheet, and a statement of cash flow. No matter what type of business you are, no matter what industry or sector or stage, you usually have those three statements. So there's the output of the financial model should always pretty much look the same. Mm-hmm. Now, what's on those statements may be different. You may have assets and liabilities. If you're a medical device company, but maybe you don't have any assets if you're just a software as a SaaS type of company. So there's some little bit of some differences there, but I'd say it's assumptions and financials. It's those three statements, and then assumptions and kind of how those turn into financials. That's when you
say three statements, you're talking P&L, cash flow, balance sheet.
Yeah, that's right. And then on the assumption side, and this also is pretty much true across all companies. Like all customers or all companies have to generate awareness, and so there's some nature of how are you getting the word out about your company. Now, the channels that you may use are way different. If you're an e-commerce company, or you're a nail salon, or you're or a biotech like you mentioned, like those may be different, but there's mechanical processes. There's kind of funnels, if you will. There's channels around how are you driving awareness? How are you acquiring customers? Whether it could be direct sales, it could be PR, it could be email marketing or organic, it could be partnerships. But you have to sketch out these channels to say, how am I getting customers in the first place? Because if I can't get customers, I can't generate revenue. If I can't generate revenue, I'm never going to turn a profit. So I kind of work down the business in this way and start with customer acquisition. And then once you have customers, you can say, okay, cool, I've got customers. Now, how do I make any money off those customers? And that's kind of the monetization piece. That's the revenue piece is, how can I sketch out, how does my revenue work? What's my revenue formula? And how am I turning people into dollars or companies into dollars on B2B? And then on down, every business has people, and everybody's got to forecast Who's
Right.
on your head count? Who are you trying to hire and when do you need to bring them on? What are you going to pay them? What other operating expenses do you have? What rent or travel, etc. And then assets, liabilities, and equity on the balance sheet side. Really every financial model should have these kind of core pieces, and within each piece, there's going to be some variation depending on your business and what's involved.
It seems like you mentioned, we are kind of what Carter is for cap tables, we are for financial models, what QuickBooks is for accounting, we are for financial models. It seems to me, just from these few minutes, like the kind of array of and diversity of financial models, depending on the business, the go-to-market strategy, might be kind of greater for financial models than it is for a cap table. Looks like a cap table, right? And there seems to be kind of fewer permutations. Is that right? Is it harder for you to build a financial model that works for every company? Are you also I'm reading Crossing the Chasm right now, and just talking about kind of focusing on a niche to get across the chasm? Are you kind of starting with a focus on a particular industry sector or stage of company?
Yeah, it's a great question. Honestly, I would say that I'd say you're right about the first piece where financial modeling, I do think is a little bit more. There's a little bit more nuance, a little bit more variation than in accounting or the cap table. There are still a good amount of variations in both of those kind of verticals as well. But financial modeling does tend to have some deeper variation, and that's really one of the number one, I would say, product challenges in this
Right.
space. Is for us kind of hitting the sweet spot between the inherent flexibility that a product like this has to have to service all those different types of companies, but still being simple and easy to use. And those things can kind of be opposing forces. So we are focused on a pretty targeted customer segment, but it's not actually, it doesn't really trend around the business model. We're pretty much business model agnostic. We can handle a lot of different types of business models at this point. It's something that we take a lot of pride in. We kind of baked it into the ground floor of Forecastr, but we focus on technology startups for the most part. On seed to Series A companies that are looking to raise venture capital. That is really where we chose to focus. And so all of kind of the context of the platform, the wrapper around the business model, and the white glove onboarding that we do, it's all meant to help early stage startups understand their business, tell that growth story, raise from investors, and then manage that runway.
Got it.
And so there's a lot of kind of contextual guardrails that are baked into the platform that speak directly to them, and that's been really effective for us.
Got it. When you say white glove onboarding, I think that's kind of helping me, because if I imagine totally self-service tool, then it's whoa, that's a lot of complexity for you to build and help kind of users figure out how to build it for themselves. When you have kind of some investment of your team's time on, okay, let me download from you, and then I, knowing your business model now and our system, can figure out how to put the pieces together. What does that white glove onboarding look like? Is that a couple of hour long calls, or you getting a bunch of information sent to you by the customer?
Yeah, great question. I'd say it's our best feature. It really is. It's an incredible experience. We got a great analyst team, and the way it generally works is, early stage company comes to us, maybe they've raised $250, they're looking for a seed round, they come to us, they want to work with us. It's $2,000 a year, Forecastr is, but we do 25% off for partners like WeFunder. Nice so definitely hit us up. But
ABC, baby.
That's right. But well, once you get started, we'll schedule a 1 hour kickoff, and we'll say, hey, send over, we have a nice little form you can fill out, send over any existing model, your pitch deck, any other resources, and some commentary about how do you acquire customers, how do you monetize those, who's on your head count, what other expenses. We collect this information and all kind of synthesize it, and the analyst team will use that to build what we call a first draft of the model. They'll load your model up, they'll build you a first draft, and on that 1 hour kickoff call, they'll set expectations and objectives for the 30 days. They'll walk you through that model and give you kind of a Forecastr 101 and say, hey, here's what we built based on the information you sent. What looks right? What looks wrong? What did we miss? What do we need to take out? And it starts this kind of collaborative process where the founding team, really is advising the analyst on their business and their particular context and what they want and what they need in their model. And the analyst is using that context to build the model out and train the customer on how it's built. And over the course of the 30 days, they typically do weekly calls, but it could be more or less. And there's kind of a transfer of ownership, if you will. Like at the very start, the analyst is doing most of the work. And as the 30 days goes through, they're having the customer drive more and more and more. So that at the end of the 30 days, nobody's left hung out to dry. They're confident that, hey, they can pick up this model, they can sit down with an investor and walk them through it, and they can use it month to month to manage a runway and hit their growth targets. So that's kind of how it works. It's
really cool. So it's kind of I honestly didn't really think about this before with buying a SaaS product, but on one hand you're getting a product which is like a financial model that is tailored to your business and is awesome and you can wow investors with and build your own confidence in your understanding of the mathematical side of the business. In another hand, you're developing the skills to kind of do that yourself. It's almost like kind of a course, right? Or you're learning this stuff as well as kind of getting the product that is built for you by other people. That's kind of a cool aspect of it. One kind of a weird question. It's just something I kind of think about sometimes with WeFunder, what we're doing. Do you kind of weigh in at all on the kind of soundness of the financial model? Or are you only basically taking the kind of crazy optimistic assumptions that founders kind of send your way and then just kind of, mathematically playing those stupid assumptions back to them? You know what I mean?
Yeah. I totally know what you mean. And we do weigh in, honestly. So that's a big part of the onboarding for us as well. It's we believe it's our responsibility essentially to offer some financial leadership. And at the end of the day, it's the customer's model. So whatever they say goes. And, and if they want to have a certain assumptions that they believe are reasonable, then we're going to support them in that. And we're going to help them get the forecast that they want to show, to investors. But we will take every opportunity we can to say, hey, here are some industry benchmarks. Here's what it looks like if you want to scale to $1 billion business over 6 to 7 years. Here's how that revenue ramp should go. Here's what you should target month over month growth wise. Here's what we think a reasonable hiring plan might look like for your business. We're going to try to provide as much advice generally, when it comes to startup finance and some benchmarks as we can. And one of the final things that we do in the onboarding, we call it the investor sniff test, is when the model's looking pretty good.
That's
we'll
cool.
Go through and do an investor sniff test, and we'll kind of put on the hat of the investor, and we'll say, okay, if I was an investor,
what would I kind of double click on and push back on?
Exactly.
That's really awesome. Actually, I started my career in management consulting, so building Excel models is something I can do. And we would oftentimes get to the end of this deep modeling exercise, and then you kind of ta-da, here it is, and then you step back and it's whoa, this is just totally, and every assumption was 10% in the optimistic direction, and then you compound that and it's nope, this doesn't make any sense. So that's a really good kind of double check, I guess.
Totally.
What are some use cases? We've talked about investors, right? Is that the primary use case for why one of your customers, you said, seed, Series A founders would use Forecastr? Are there other kind of reasons why it would be good for companies to build out a super sound financial model and work with you guys?
Yeah, totally. I kind of break the use cases into 3 main areas for early stage companies. And that is, really supporting your story and raising capital. That is a big use case for us is, you're going out there to raise capital. Finance is the language of investors. Investors are expecting you to be able to speak to the numbers and how is your business going to grow and how is it going to generate a lot of return for me as an investor. And your pitch deck is great at being the sizzle, but I always tell them that the model's the stake. The model's kind of it's backing up the narrative and helping you kind of tell the exact same story that your pitch deck tells, but in a numerical way. So that raising capital is a big use case. The other 2 are on the operational side. They're on the side of running your company. one of them's offensive and one of them's defensive. So one of the big use cases of a model is making sure you hit your growth targets. I think if you're an early stage founder, you've got to grow. Like you have some pretty high bars that you need to jump over when it comes to growth. And if you don't have a really good way of setting those targets, and you don't know how many meetings you need and how many customers you need and how much traffic you need and what average price you need to hit those growth metrics and to hit those revenue milestones, it's really hard to get there, And so one of the big use cases for a financial model is, hey, you need to get to 150K in MRR by Series A. Well, let's break that down into a set of monthly operational KPIs.
This is not just how many customers we need to onboard in January, but this is how many calls our BD team needs to set up with customers in December.
Yeah, like let's make it as controllable as possible so that you can take that to your team and say, okay, we got to get this many calls. We need to hit this conversion rate. I'm tracking all those metrics. And if I do go off the rails, which totally happens, like you set a forecast, you maybe don't hit it.
Yeah.
You use a financial model to look at where you missed and then make some tweaks and make sure you're on track to hit those targets.
Runway. That's the defensive thing.
That's the other thing. That's the defensive thing. Yeah, is the runway. It's like, you're ticking time bomb usually. So it's like, you got to make sure that, if you're running low on runway, kind of course correct, maybe make some cuts or try to increase your revenue or go ahead and start that next round. I think a lot of the founders that I used to work with would unfortunately kind of come to me a little bit too late. A lot of times they didn't have a model. They'd come to me, they wanted to build a model because they wanted to raise capital, but they'd only have like 2 months of runway left. And there's really little that I could do for them at that time. And it's really a shame because a lot of these had great businesses, but they just weren't watching. They just weren't watching the cash. And so it happens a lot. And if you have a good financial model, it'll really help you keep a beat on that fume date so you can plan accordingly.
Yeah.
Because gas is like oxygen to the business. You're without it for a few minutes and you're dead. So you got to keep that one in the bank.
Do you see this as being a kind of, you mentioned seed and Series A, where you're starting kind of, beachhead wise from a target customer perspective, but do you see yourself always as kind of working in that sweet spot? I would imagine that as companies get bigger, they're building out, they're hiring a CFO and like a financial team whose kind of responsibility is to do that. Do you think kind of your customers are going to bring this kind of functionality in-house over time, and so your churn rate is going to kind of climb as companies get later stage? Or
yeah, it's a great question. So here's how we view it, kind of like this. We view it like, when you're at the early stages of a company, let's say, like even for me right now as the CEO, I don't have a VP of sales, and so as a CEO, I'm kind of the VP of sales, and we use HubSpot as a CRM and got all my data in there, and I'm managing that. I'm the owner of that. Mm-hmm. But once we get a Series A, I'm probably going to bring in a VP of sales, and we're not going to ditch HubSpot and go back to a spreadsheet. I'm going to transfer the ownership of that to my VP of sales. And
you don't ditch Carter when you hire a general counsel. The general counsel uses Carter to
and I think it's the same thing for us. It's like we target that CEO. We want to make it easy enough to where they can get the insights they need, make decisions. But once they get that VP of finance or a CFO, we want to transfer ownership to them. And the goal of Forecastr really is to like supercharge the process such that the me's of the world, Logan's of the world, the CFOs of the world, they're only spending time in the financial model doing what they're at the company to do, which is provide strategic insights to the management team. That's why they're at the company, not to do all the manual data entry and tweak all the Excel formulas. It's to provide insight. And so we want to try to strategically leverage a finance team's time and give them the same treatment that the sales team has, that the accounting team has, that the marketing team has in these online integrated web apps.
Got it. What are some common mistakes that you've seen? Like you mentioned just one, like kind of leave it too late, then oops, we got 2 months of runway and it's kind of delayed in the day to turn it around. Yeah. What are some common mistakes you see founders making in terms of their approach to financial modeling or lack thereof?
Yeah, it's a great question. I'd say, to be honest, the number one mistake is not building one. Like that is still kind of plaguing the market, so to speak. A lot of people are building their businesses without a financial model. And that's like driving a car, looking through the rearview mirror. You're flying blind. It's really hard to make a data-driven decision without any of that data. So definitely build a model. Like,
can you go too far the other way as well, where the real world is messy, the real world is complex. I had this great quote, I think it was in Crossing the Chasm recently, like intuition kind of oftentimes like trumps like data and analytics. Like, have you seen founders go the other way, where it's like, we're really focused on our financial model, we kind of take our eye off the ball, that like, actually this opportunity here doesn't neatly fit into the financial model, but could be the game changer?
I think that's a great point, honestly. I think when I think about financial modeling, I think it's all about right sizing the model to your stage. I think you're dead on. I think really complicated models early on is just a lot of false precision, and you can kind of be worse off from that. So I always advise people, and this is why I think you can bring the barrier down. I think a lot of people don't build a model. They think it needs to be so complex. It doesn't need to be. It's like, you can build what I call an MVP model. You're an early stage company. Build an MVP model. Build a simple financial model that you'll use.
Love that.
It guides your intuition, so you stay in a band, but then you're making all those decisions within that band. I think like that's really the best way to do it. And then as you get more data from the market, you're increasing the resolution of that model, and you're going deeper. And that's why big companies have really complex models, and early stage companies, they should have simple models. And that's what we really advise people to do. So but I guess building a model is the number one thing that I see people
just on the MVP thing. One thing I learned in consulting is like, you'd have this partner, and he would like give this kind of analytical exercise to a junior analyst, and they would go away for 2 days and work on a super complicated model and like bring it back, and then he'd be like, oh well, this actually was in the wrong direction, so all of that 2 days is wasted, right? So what you want to do, I kind of talk about MVP approach to analytics, where it's like, okay, in 30 minutes, what is the answer to this analytical question, right? Super simple assumptions, super kind of simple model. And then, okay, now let's kind of look at this. Is this heading in the right direction? Okay, now we can go and like dive deeper on the assumptions and more sophisticated assumptions. But I really like that approach, kind of MVP approach to analytics. I talk about MVP approach to fundraising on WeFunded sometimes now as well, where with the new law change, you can launch a campaign and test the waters in 15 minutes, and so rather than kind of waiting to get the perfect pitch deck, perfect video, waiting for months and months, just as with kind of Reid Hoffman's quote, right, of like, if you waited too long to launch a product, if you're not embarrassed by your first product release, you waited too long to launch it. Same thing. It's like, you can have a WeFunded campaign up in 15 minutes. You start to share it around people. You get feedback from them. They help you tweak it. And it's kind of that like in the market, in the real world approach to iterating on a product. In this case, your fundraising round. In your case, your financial model. But I think, MVP it's not just applied. It's not just relevant for kind of startups, right? You can apply it in like so many different facets of startup life.
Yeah, I totally agree with that. I totally agree. I think it's honestly, it's a great way of thinking about things, and it really takes the pressure off in a lot of ways, and it kind of allows you to be a lot more effective when you look at it like that. The other thing I was going to say with respect to things that people don't do or are doing correctly, maybe when they're building their model, is just they don't go deep enough on the revenue side. I see a lot of models that just assume some kind of month-over-month growth rate to revenue, or they're just keying in how many customers they expect in a certain month, or maybe they're forecasting revenue annually instead of monthly. But either way, like they're just not zooming in enough on the revenue side. And
I wonder if like volatility is something as well, where like, if you zoom out, right, year over year, WeFunded's growth looks amazing. Quarter by quarter looks super great, right? Month to month, if you're looking week to week, it's like, yikes, it looks really scary, right? And so, but then obviously that volatility, sometimes if that like, slow quarter, seasonality impacts you, coincides with like, you're getting kind of, towards getting tight on your runway, like, do you kind of factor in like that kind of volatility into the model as well? I've never really thought about that. With normally financial models, right? It's like you might get detailed and granular on the assumptions, but it's still kind of up and to the right versus like kind of almost like a randomizing function around volatility, you know?
Yeah, it's a great question. There is always that volatility, and it is really hard to put that into a model because it is kind of another form of that false precision. There's a certain level of randomness where you can't predict it, and so if you're trying to predict it, well, it's just as good as kind of doing a straight line. And that's why what's really important in financial modeling is having that monthly model and updating it once a month with the actuals, so that you're drawing a new line every month and you're always keeping a beat on what it might be, rather than saying, well,
that's a good point. That's really good.
And here I am in 2022, and I could die in the middle, because I might run out of cash, but I don't know. So you want to kind of zoom in that way.
It'd be interesting is like some kind of statistical significance calc on, okay, like we're like missing our revenue projections for these 2 months in a row. Is that like within the noise? Could that like be within the noise of just kind of statistical randomness? Or like to what extent can we be statistically confident that there's like some fundamental underlying problem? I think that would be kind of interesting, because sometimes I think I've seen this at WeFunder, kind of growth is flat for a couple of months, and it's like, oh, like alarm bells ringing, but actually maybe that's just, it's kind of relatively illiquid. We have like a couple of $5 million campaigns, and that's an amazing month. I think that would be kind of interesting to just, think about. This is my product feature request for you, Stephen, coming out of the same
thing. I will log that in Canny for us. I love that. And the last one I was going to say, which we've already kind of been talking about, is only using it for fundraising. I see a lot of folks that build a model. Maybe they build a great model, but they only use it to raise capital. And once they're done, they just kind of put it on a shelf. And that goes back to what we're talking about, how you really need to be using this thing on a monthly basis to make sure that the assumptions that you thought were true when you raised that round hold true. And if they don't, you need to ask yourself why. You need to run experiments. You need to run tests. You need to make course corrections to make sure that you are on track to hit those milestones. Because everything changes so frequently, and it's so hard to have those assumptions all be right. And that you're always going to make mistakes in that way. So using the model month to month is critical, and we see a lot of people not doing that.
Your go-to-market, I imagine, is mostly focused on reaching out to startup founders. So just had the idea of like, I imagine you could also kind of, be pitching VCs or accelerators, and it's like, hey, wouldn't it be good if like every startup that you looked at was presenting like information to you in the same standardized way? I was talking to the guys at 212 who have this kind of cap table management software, and they have like cap table kind of forecasting. And their pitch to, VCs is, wouldn't it be cool if you could do this kind of forward-looking modeling on what the cap table looks like? Are you kind of employing that kind of channel-based approach to go to market, or just kind of directly pitching founders at this stage?
Yeah, no, it's a great point, Jonny. So we are definitely taking kind of a partner-based approach, I would say, but from two sides. One side of it is just around this education. I think there's really a lack of education in the market about startup finance and financial modeling. And so we do actually work with a lot of accelerators and VCs in these communities, just providing leadership and education on financial modeling. And as a result,
you're like doing the presentation as part of Techstars, where like their founders are kind of hearing from you on building a financial model.
Totally. And we always have our education, like, it doesn't require a Forecastr, right? We just educate on how to build a great model. If you want to do that in Excel, we want to support you. If you want to do that in Forecastr, of course, we're thrilled to work with you. But we want to teach you how to build a great financial model. We want to teach you how to use it. So we do a lot of that. And we're actually building these feature sets like you're talking about right now, where there's the ability for an investor or an accelerator MD to have a login that can get in all their companies. And wouldn't that be great that you could see how your companies are doing? You could see the ones that are at risk, and you could prioritize your outreach and your help to go to those companies that seem like, they're pretty low on runway, or they're missing their growth targets, and you can make sure you can help them, achieve that next milestone. So I think that's going to be a big piece.
That's really cool. Last kind of question, maybe penultimate. You can have the third of these bullet points be, you all should check out Forecastr. But what are kind of three tips and tricks that you have for founders as they're, either building a first financial model or thinking about the financial model they have? What are three things they can do to get it right?
Yeah, that's a great question. So the first thing I'll say is the first thing you should do when you think about building a financial model is take the time to understand what I'll call your revenue formula. Your revenue assumptions and the formula of how your revenue is generated, that's where almost all the risk is in your business typically. And that's really what you have to understand as a founder. If you're going to hit the growth trajectory and if you're going to communicate that story to investors, you've got to know, how do I acquire customers and how do I monetize those customers and generate revenue? Within those two pieces, it breaks down. What's that?
How do they churn?
Yeah, how do they churn? What kind of repeat behavior is there and what channels do I use? You kind of go into these areas, but acquisition and monetization, that revenue formula, 80% of your thought should go into that. That's really the piece that all the risk has.
Revenue side is basically customer acquisition and monetization. And then obviously the churn kind of is a component of monetization, right? Repeat customers is an element of monetization. CAC is an element of acquisition. But having that kind of two kind of pretty simple, two-part framework of building up to revenue is kind of cool. So that's number one.
Yes, that's number one. I would say number two, it's got to be monthly. And I hit on this one because I just see a lot of forecasts that are quarterly or annually, and it's not enough resolution for an early stage startup. Too many things happen too frequently to do it at that resolution. So build it monthly, and if you build it monthly, you can sum it quarterly, sum it annual, and you have those great zoom out views for investors. But you gotta build it monthly. So that would say that's number two. And number three, I'd say you got a model that's focused on revenue. You've got a model that's monthly. I would say all three financial statements is probably the other big recommendation I would give, because I see a lot of models that maybe are just a revenue forecast, they're just an expense budget. Right. They do some of the work, but they don't put it in the format of an income statement, balance sheet, and a statement of cash flows.
Cash is king, as they say.
It's king. And a lot of people think their net income is their cash, and it's not. And I've seen companies get really sticky spots on cash because of that. And there's actually a few other reasons.
We fund that as maybe been there in the past.
Yeah. Well, and it's kind of the bedrock of this monthly playbook we talk about of comparing your forecast versus actuals. When your accountant does your books and they send those to you, it's going to be in the format of a profit and loss, a balance sheet and a statement of cash flows. And if your model isn't in that, it's apples to oranges, and you can't make that comparison. And as a result, you can't really learn a lot from that. It's also the language of investors. Investors are going to expect that. And if you can't speak to the statements, they're just a little alarm bell is going to go off in there and say, maybe this founder isn't going to be a good shepherd of my money. Maybe they don't really understand how finance works. And so that's what I'd say is they focus on revenue, build it monthly, make sure you got all three statements. And certainly if you're interested in working with Forecastr.
And number 4, check out Forecastr.
Definitely check out Forecastr.
Yeah, that's awesome, man. This has been a great conversation. One of my favorite ever quotes about management, probably life actually, is what gets measured gets managed. Peter Drucker. And I say life because I have an app on my most people do step counter, right? And start of this year, I was hadn't really looked at it, or hadn't looked at it for years, and just looked at it. I was like, oh, I am not doing enough steps. Looked at it, I was like, I'm just going to look at this. And just looking at the app, the number of steps I've taken per day since I started looking at the app is about doubled. Wow. So not just for your startup, but what gets measured gets managed can apply to many different areas of your life as well. Okay, this is the last question. One tip can be about financial modeling or can be about something else, but one tip that Stephen would have for a startup founder, either at the start of the journey or kind of where you are, a couple of years in.
I got a good one. So, and this is it's a tip back to myself when I first started my first company, because I didn't do this. Evangelize your company early and often, and always keep doing it. If you're a CEO, one of the main things you need to do is build a tribe. The power is in the people. This is what I've found in my life. If you build a tribe of people around your business, they're going to connect you to investors, to customers, to partners, to potential employees. Like it's people that power your business, and you need to get out there and spread your idea from the mountaintops. And like for this company did a great job of that. 12 months, when I was incubating a venture first, I started to tell everybody I know, hey, I'm planning on starting this company called Forecastr. This is what we want to do. I built up a big tribe, and I specifically did this with a lot of investors way in advance of needing capital. And so when it came time to raise that $750K pre-seed, and also this was true for my $2.5 million seed, I already had a deep Rolodex of investors who knew me. They trusted me. They knew Forecastr, what our brand was all about. They'd seen our metrics over the past year. And it was a much quicker conversation about, do I invest and do I not, than who are you, who's your company, and what are you doing? Right? So get all that out of the way early and just really evangelize. You'll be glad you did. It takes a lot of time, but it pays off in spades.
Well, Stephen, I will slip you the $20 bill under the table later, because when you say build your tribe is your one kind of best advice to startup founders, that is what we are doing at WeFunder, right? Which is like raise capital, sure, but recruit this army of, now customers, now investors who have an ownership stake in Forecastr, and are going to tell all their friends about it. That's what we're trying to do with community rounds, is like helping founders build their tribe, not just accredited investors, not just institutional investors, but customers. That was a nice, thanks for just kind of putting that on a tee for me to knock out of the park there and wrap things up. But yeah, this has been a really awesome conversation. Hopefully it'll be useful for some founders that are kind of wrestling with these issues of financial modeling. And hope to get up to Louisville and meet up in person, or have you down in Nashville sometime soon. But thanks so much for joining us today.
My pleasure, Jonny. I really appreciate you having us on. I love the work that you guys are doing over at WeFunder. So appreciate it, man. Have a good one.
Yes, bye.
Thank you for tuning into another episode of Adventure Capital. I hope you laughed, took notes, shed a tear, and most importantly, feel ready to go off on your own adventure. And remember, whenever you are ready, WeFunder is here to help.